It's a pleasure and an honor to introduce Richard Roll, Emeritus Professor at UCLA and Lind Institute Professor of Finance at Caltech. His lecture is entitled A Protocol for Factor Identification and is based on a joint work with Kuntara Puktuantong from the University of Missouri. Starting from the wide agreement about the existence of multiple factors driving asset returns, as well as the existence of a wide debate about their identities, Professor Roll and his co-author suggest a protocol for their identification. Please, Richard, the floor is yours.
Well, thank you, Elyès, and thanks to Marie Briere for organizing this great conference and the Institute, and I appreciate having had the opportunity to come to France again. I spent the last week in Dordogne where I had foie gras every night for dinner and free a kilo. It's always a pleasure. Let me get started. We have, following me, I have about 45 minutes to give a talk on factor modeling, and then there's a panel that you will be introduced to later after my talk on the same, more or less the same subject. So this paper is not a paper that tests a theory, it's a normative paper. It's a suggestion that we're trying to make to come up with a procedure to identify factors that people suggest are risk factors and that have risk premiums, or that maybe they're not risk factors, or something else that do not have risk premiums, or there may be characteristics, as we'll see. I'll try to distinguish among these things. But what we want to do here is to try to popularize a procedure that both academics and practitioners can use when somebody suggests that here's a new factor that's driving asset returns. So it's normative in the sense that it's like we're trying to come up with a method here, not to test anything particular, although we do have some empirical examples in the paper. The main purpose of this is to suggest to all of you and people in the profession how we might go about doing this. Now, I want to just start by giving you some simple evidence about why this is an important topic. I really shouldn't have to do this because it's in everybody's minds these days. Factor, smart betas, and things like that are certainly in the ascendancy. I happened to start working on multiple factor models 43 years ago when the arbitrage pricing theory first started out. But it takes a while for this stuff to get popular. But let me just give you an example about why empirically, I think multiple factors are the right way to think about things. If you look at a big diversified portfolio, let's take the S&P 500 in the United States, generally what you'll see in that diversified portfolio is that it does reduce risk by diversifying, but it doesn't get rid of risk completely. So for example, the annualized standard deviation of the S&P in that decade ending in 2010 was about 16%. The average volatility of the individual issues in it was about 36%. So you can see that there is a reduction, but it's not a complete reduction. The second fact there that's shown is that the correlation coefficient between big diversified portfolios, for example, between the S&P 500 and the Barclays Aggregate Bond Index, or between those indexes and the Goldman Sachs indexes, are generally quite small. So the correlation coefficient between bonds and stocks in that decade was actually minus 0.04 when you look at a big diversified stock index and a big diversified bond index. Now, what does that tell us about multiple factors? Well, the first thing it tells us is that since you form a diversified portfolio and you don't get rid of all the risk, there has to be some common underlying factors that are common to all individual securities, and they still show up as driving the big diversified portfolio. If that weren't the case, then a big diversified portfolio would have practically no volatility. So there has to be at least one common factor within the S&P 500 stock group in order to have that happen. That limits diversification for an individual asset class, such as stocks. But the second thing that we notice there is those correlations across asset classes are quite low, and what that has to imply is there are multiple factors. There has to be more than one factor, because if it were the same factor in bonds and stocks, then the correlation coefficient between the two diversified portfolios would be very large and not small as we actually observe it. So that simple empirical fact, as you can see from looking at diversified portfolios, tells us that we need to be able to handle multiple factor models. Everything else, is kind of just conversation. But the key thing is that what's driving asset returns around the world today are multiple factors. Now, there's general agreement about this among academics, at least. Multiple factors do drive asset returns, but what's not known is what are they? What are the identities of these factors? And what we're trying to suggest in this paper is a procedure for taking a particular factor, a particular group of factors, and seeing whether or not they really satisfy the conditions that we need for a factor. Our goal is normative, which is to come up with an acceptable procedure. Now, there are certain principles that can guide us in this quest. One is the factor itself should have movements that are not easily predictable, which means that the changes in that factor, let's take something like a market index as a factor. Those returns on the market index should not be forecastable very easily. If you have a characteristic such as firm size or anything else known in advance, that cannot be a factor, because since you know it in advance, it's not going to change asset pricing when the realization comes along. Of course, characteristics can be related to mean returns for two reasons. One, they happen to align with factor loadings. That is, the betas on a particular factor might happen to be cross-sectionally correlated with the characteristic. I'll give you an example of that in a second. Or the second reason is that the characteristic might be associated with arbitrage opportunities. It may be really related to mean returns and not related to volatility or risk at all. And of course, if you could find a characteristic like that, it would be a great thing to focus on in terms of producing alpha for clients. Pervasive factors, that is, those factors that academics say have risk premiums, have to satisfy some criteria. They generate covariances among returns on real assets. When I say by real assets, I'm talking about if we add up all the assets in the world and we look at that big diversified portfolio, a lot of things cancel out in that diversified portfolio, such as bonds, for instance. Some people are long bonds, some people are short bonds, options, derivatives, and things like that. That global portfolio doesn't really contain a positive net position in any of those kind of assets. So when you think about it, these real assets, the things that represent plant and equipment, goodwill, things that the covariances among those assets are the things that we can't get rid of in aggregate. So it's really those covariances that we should be focusing on when we try to identify a factor. It doesn't mean that we have to neglect bonds and derivatives and things like that, but it's probably more efficient for us to start out right away with things that are held in positive net supply, such as equities, or at least part of these equities. So real assets only need to be explained by the factors. 90% of the previous academic research is focused on equities, but leveraged equities are really hybrids because, of course, a leveraged equity is short debt, among other things. And unlevered firms, real estate, commodities, and human capital are really the things that we should be focusing on. Of course, I don't need to mention that a lot of these things you can't measure very well. In particular, human capital is probably impossible, but it's a real asset that belongs in our investigations. We don't need to explain derivatives or bonds. And nonlinear factor models are mainly about assets in zero net supply, so I'm going to skip over those nonlinear factor models, which are interesting in themselves, but I don't think we need to worry about them for this particular purpose. Let me talk a bit about factor models based on characteristics. As I said, a characteristic cannot be a factor, but it can be related in the sense that it's cross-sectionally correlated with a beta or a factor loading. So for example, we have size, book to market, momentum, beta itself, modified duration, beta estimation risk, even the letter beginning of the firm's, a letter that begins the firm's name. Those things have all been used as characteristics in factor models. And they could be associated with factor loadings. So a long short portfolio, for example, in book to market, that goes long, high book to market stocks and low book to market stocks, could be associated with betas that are cross-section related to some factor. But once you've built that factor based on the factor loadings, the characteristics that you observe in advance, you don't really know what the underlying factor is. The factor itself is some underlying stochastic driver that has betas that are associated with book to market, but just by calling it a book to market factor doesn't really tell you what it is. So that's a good example, and Fama French in 1992 had their famous paper on where they popularized the three-factor model. Book to market was in that paper. They took a portfolio which is long, higher book to market and short, lower book to market stocks, and they showed that drove asset returns. That is, that portfolio that was constructed to do that itself had returns that were unpredictable, but it did seem to be associated with returns. Daniel and Titman in a 97 paper followed up by the observation, the correct one by the way, that book to market is not a characteristic. It is a characteristic, not a factor. And they showed that stocks which had higher book-to-market ratios but not higher loadings on the Fama French book-to-market portfolio, they showed that those stocks also had higher returns. So what that says is that even though they're stocks that have high book-to-market and they're not related to the volatility in the Fama French book-to-market portfolio, they have higher returns than other stocks. So that suggests that in Daniel and Titman concluded that suggested that book to market was a characteristic that was associated with an arbitrage and not a risk factor in the true sense of being associated with volatility. But of course, what they couldn't and didn't do in that paper was to show that there was no other factor, not the Fama French one, but some other unidentified factor that was related to those particular stocks that they constructed in their example. And so they really weren't able to satisfactorily prove that book to market itself was a profit-making opportunity. So these price characteristics, so if Daniel and Titman were right, these price characteristics that are not associated with risk are really alluring. If we could identify characteristics that were associated cross-sectionally with mean returns, but not to the volatility of returns, we'd really have something. Now the problem is that academics, and I think practitioners even more so, have identified so many different factor candidates that it's really hard to sort out what's going on here. There was an earlier paper by Subra in 2010 which looked at 50 cross-sectional characteristics that have been used to predict returns. That was in 2010. 2016, just a month or two ago, Harvey and his co-authors produced another paper where they identified 316 factor candidates that have appeared in the asset pricing literature. We got 316 supposedly tested factor candidates, and we need to sort out those ones to see what they're all about. So if the world were really very simple, what we could do is to identify a factor. A surefire method would be to extract factor proxies from the covariance matrix of returns. So We could generate a covariance matrix of returns. We could extract principal components from the covariance matrix of returns. And if it were a perfect world, then we would be able to relate those principal components from the covariance matrix to the factor candidates. The idea here being that if a factor candidate's variation were not related to any of the principal components and returns, it can't be a risk factor. So it can't be either a risk factor that's got a risk premium or a risk factor that doesn't have a risk premium. The key thing here is that the factor itself, the returns on that factor candidate, must be related to the covariance matrix. And one way of identifying whether that's true or not is to do principal components on a covariance matrix and then to see if any of those principal components are related to the factor candidate. So if it were an easy world to deal with, we would only have a few principal components that would be identified from the covariance matrix, and we could extract those principal components from a relatively small subset of assets. We wouldn't need that many assets to do this if we thought that the world were characterized by just a few dominant factors. And we could work with a fairly small sets of assets for that. So a necessary condition for a factor to really be a factor is that it has to be related to the principal components of the covariance matrix of returns. Now, we're not the first people to notice this. There was a paper published in 2003 by Moskowitz where he looked at exactly this. He derived some principal components from covariance matrices, and he checked to see whether size, the book to market, or momentum were related to the principal components using the Fama French portfolios that were constructed with size, book to market, and the Carhart momentum portfolio. And he concluded that size was identifiable as related to the covariance matrix, but the book to market portfolio in the momentum was not. So even though momentum and book to market are widely used and appreciated by both academics and practitioners, according to the Moskowitz paper, neither one of those is really related to riskiness. It's not related to riskiness because no component of the covariance matrix is related to those returns on book to market and size. Now the problem is that this procedure, I started by saying if it were a perfect world, this would be an easy thing to do, but it's difficult to do this in practice for a number of reasons. One is the factor extraction and working with a covariance matrix produces only estimates of the linear combinations of the true underlying factors, not the factors themselves. So let's suppose we have 10 factors and we extract principal components from a covariance matrix. Each principal component will be some linear combination of all 10 factors. Now the difficulty is that no one of those principal components will be related strictly to one of the underlying factors. They'll each be some linear combination of that. The second problem is that there's no reason theoretically why these things should be stationary over time. We have to admit that both the covariance matrix and the risk premiums and the volatility and all those kind of things are changing over time. And we have to have a procedure or protocol, if you will, that would take care of that important aspect of asset pricing. The third thing is that the principal components method extracts true risk drivers, pervasive non-diversifiable factors that we're really interested in, but it also extracts factors that are not associated with risk premiums, like industry factors, for instance, that drive some stocks or some assets, but not all of them, and therefore they don't have risk premiums associated with them. And what we need is a procedure to sort out, once we've extracted the things from the covariance matrix, we need a procedure to sort out which ones are in the true risk premium category and which ones are in the risk driver category that doesn't have risk premiums associated with it. Because the second set of factors, the best procedure is simply to diversify away as much as possible those second factors, since there are no risk premiums associated with them. And we have our protocol suggests a cure for each of these difficulties, for the non-stationarity difficulty, for the difficulty of extracting factors that are both true risk premium related and those that are not, and so on. So now I want to talk just briefly about what are really, theoretically at least, the underlying factors. Well, basically they're perceptions. They're macroeconomic quantities that move all assets in some sense. When the unexpected macroeconomic quantity changes, then all assets change to some extent in one way or another. The underlying risk drivers cannot be official numbers, official macro numbers about macroeconomic events, because market prices move around every day and they're correlated with each other every day. So what has to be happening on a high frequency basis is that people's perceptions about the underlying true macroeconomic factors are changing on a daily, hourly, and actually a minute-to-minute basis. So since we're talking about perceptions and not actual numbers, official published numbers from the government about macroeconomic variables, then we have to admit that these perceptions could include rational estimates of the true underlying macro conditions that are pervasive. Let's say real output growth and interest rates, inflation, energy prices, and those kind of things. And they could also include perceptions about behaviorally driven underlying factors, that like confidence or risk tolerance or that kind of thing. So we have to be able to recognize that those perceptions include those things. Now, I'm going to jump over this, but just previous factor measurement methods. Some are statistical. You can see that one paper that I did way back in 1980, that's 36 years ago, published, I think we did it before that, used principal components in factor analysis. Macroeconomic variables were used even though they're low frequency in a bunch of papers. Characteristics that are empirically related to average returns, that's the Fama-French Carhart method. And then a lesser known but a simpler approach, which I think is promising, is simply to use a handful of rather heterogeneous indexes or tradable portfolios, which are heterogeneous enough to span the true underlying macroeconomic factors. And they don't have to be uncorrelated with each other, but as long as you span the underlying factors, you can simply use a set of indexes or tradable portfolios. These things have pluses or minuses. For example, the statistical method is sound theoretically, but stationarity is a problem. Macroeconomic variables are low frequency. Characteristics like Fama and French, they do accommodate non-stationarity, but there's no theory whatsoever to tell you about them. There's no theory about why book to market is associated with a particular beta on an underlying macroeconomic factor. We don't have any idea why that is. It seems to work, but it's not very satisfactory theoretically. What about using the fourth method, heterogeneous as index or tradable portfolios? That's an easy and good way for non-stationarity, but you have to make sure that there's enough heterogeneity across the tradable portfolios that you use to accomplish that. I think ETFs are a promising way to go. ETFs are diversified portfolios, or they're based on derivative equivalence. Their returns are mainly driven by underlying factors, and of course they're high frequency. You can observe them minute by minute trading on the exchanges. Their idiosyncratic volatility should be relatively small if they're based on well-diversified indexes. They're generally liquid, they're transparent, they're cheap to trade, and they have tremendous variety across asset classes and a healthy degree of heterogeneity. Of course, you don't want to use a bunch of ETFs that are all equity ETFs that are all linked to the S&P 500, for instance. You want to spread out your heterogeneity across different asset classes and different countries even. And really, this procedure of using ETFs is proxies for linear combinations of the underlying macro factors is really unexplored territory, but I think it's a territory that's worth exploring. So our protocol really involves a set of steps that I'm going to go through now, necessary and sufficient conditions for you to sort out the different factors and identify which ones have which particular qualities. To be judged a factor, a candidate must survive a series of 6 hurdles that represent the necessary condition. Here I'm saying to be judged a factor that is a true risk driver, it has to pass these hurdles. To be a price factor, one that has a risk premium associated with it, it must pass those 6 conditions plus a sufficient condition that I'll describe later. And I'll show you what they are and give you numerical examples for each one. So step number 1, we're going to use real asset returns. So we're going to collect a bunch of asset equities, for instance, that don't have much leverage in them. You don't have to do that, but we think that's an efficient way to do it. That's a pretty easy step. We're just collect returns on unleveraged equities for firms that don't engage in much hedging or derivatives. And these are going to be the ultimate dependent variables that we're going to use. We could also use other things like real estate and things like that if we could get our hands on good data for that. The danger there is we might exclude some industries, but I think if you get a large enough group, you can't read this, but here is a list of 30 stocks from the US out of 1,100 that have almost no debt. So actually there are quite a few stocks that are traded in the US that really satisfy this condition that, there's not much leverage in them, and we're going to use those. The second step is we're going to collect a set of K-factor candidates that consists of 2 subsets. Spanning portfolios, such as, let's say, J ETFs. So let's say K is equal to 5. There are 5 factors we want to investigate at the same time. We're going to pick, let's say, 10 ETFs. J is equal to 10 here, a half dozen or so, that are heterogeneous as possible. The J ETFs are kind of our proxies for spanning the true underlying factors because they seem to satisfy all the conditions that we need. So we're going to have K minus J factor candidates of interest. For instance, let's look at size, book to market, and momentum, or any of the 50 or so documented in Subramaniam, or any of the 316 factors from Harvey. We'll put those into this washing machine and see what we get out at the end. So here's an example. What I've got here is not anything more than an example of applying this procedure, right? So here are 7 ETFs that are pretty heterogeneous. You can see that we have a Japan index, a Hong Kong one, a real estate one, the S&P 500, and so on. So the idea here is heterogeneous ETFs spanning the underlying factors. Step number 3, we're going to select a set of real asset returns. You saw those non-leveraged securities. And we're going to calculate, and here's the key thing, a conditional covariance matrix. Conditional means every single period, in our example here it's monthly, every single period we're going to have a different covariance matrix. Now, how do you do that? How do you calculate a different covariance matrix month by month when you only have one extra month of data as you go forward? That's a trick that fortunately people have been working on. One method that we actually use in this is in a paper by Ledois, Santa Clara, and Wolf, a 2003 paper, where they provide a method of calculating a covariance matrix just by updating the data monthly and getting a new covariance matrix every month. Now you can see the advantage of that is we have non-stationarity that we have to deal with in the data. That's a way to handle that non-stationarity. So it produces a positive, semi-definite, but time-varying covariance matrix every month. So what that means is that once we've got that monthly estimate of the covariance matrix, we can extract the factor, the principal components from that conditional covariance matrix. So that's step number 4. We extract from each of these the principal components. And then step number 5, with the K-factor candidates from step 2 and the risk portfolios, which are the principal components from step 4, we're going to calculate covariances between them. Okay, so we're going to have a covariance matrix there. This is just an example of a conditional Ladois, Santa Clara, and Wolf covariance matrix. I'll skip over that. And using the matrix of covariances, we're going to then compute canonical correlations between the principal components and the factor candidates. Now, canonical correlations, I'm going to just give you the intuition of this, is essential here because, as I mentioned earlier, we only have linear combinations of the true underlying macroeconomic perceptions in both the factor candidates and in the principal components. So what we have to do is have a technique so that we can relate those two different sets of linear combinations to each other. That's exactly what canonical correlation does. So I'm going to skip over the math of that since I don't have much time. But basically the intuition of canonical correlation is that the true underlying risk drivers are undoubtedly changes in perceptions about macroeconomic variables. The factor candidates of the risk portfolios are linear combinations of them. So we have what canonical correlation does is then relate the two different linear combinations of each other to see if they're related. So basically, the intuition there is that a good factor candidate must be related to some linear combination of the risk portfolios. Suppose you, at this point, find a factor candidate that's not related to any of the risk portfolios, but it's cross-section related to mean returns. Well, what we show in the paper is that you could construct virtually a risk-free portfolio that has higher mean returns, or a higher Sharpe ratio, if you will, than anything else. It's not related to the underlying factors. It's an arbitrage, or a quasi-arbitrage. Okay? And that's a rejected factor candidate. So actually, those are more interesting in some sense than the ones that are true risk factors. Okay, let's see, I've got 5 minutes. So if you want to profit from these rejected factors, we can construct a profitable low-risk portfolio. We need the factor loadings on the true underlying factors to do that, but we can go long short in such a way that we get 0 factor loadings on the true factors and produce a positive return. That essentially gives you a profitable method of doing this. Okay, here's canonical correlations. I just go skipping through this. Basically what we did is we found that both about 5 of the 7 ETFs and all 3, size, book to market, and momentum, were related through canonical correlation to the underlying factors that we got from the conditional time-varying covariance matrices. So at that point, we can say they all passed the first 6 hurdles. 5 of the 7 ETFs and size, momentum, and book to market. But the question is now, are they related to a risk premium? So the final step here is we do a Fama-Macbeth type of procedure, but with an innovation that allows us to use individual stocks or individual assets using instrumental variables. And basically what this allows us to do is to identify which one of these factors that have passed the first 6 hurdles is associated with risk premiums. And I won't show you the example here, but basically of the 5 ETFs, 4 of them are associated with risk premiums. We'd expect that because ETFs, after all, are spanning the underlying true macro factors. And of size, book to market, and momentum, only one of those has a risk premium, and that's momentum. So we didn't find any evidence that even though size is a risk driver, we didn't find in that particular decade that it had a risk premium associated with it. Momentum did, though. So the point of this is really not to test whether momentum is right or size or book to market. It's just to provide a procedure that we can all agree on when the new candidate for a factor is nominated. We can say, let's put this candidate through a bunch of tests to see whether or not it's related to risk, and if it is related to risk, it's associated with a risk premium or not, or it's unrelated to risk, in which case it's something that you can make money from if it's cross-section related to mean returns. So sorry about skipping through these things. I think I'll stop there. Okay?
Thank you. Yes, I find your identification strategy very relevant for practice. Because there is now, this fashion about factor investing and diversification across factors. And one of the key questions is how do they diversify? But if I understand properly your methodology, what you come up with are long-short combinations of factors at some point. So these are independent, so that's great in terms of the diversification perspective. But many investors have long-only constraints. So this is not achievable. I mean, they have short-selling constraints. So this is not necessarily achievable for many investors. So then it's more a comment than a question, but the identification strategy is very interesting, but that doesn't solve, for me, the problem of building an asset allocation across factors, because you come up with independent factors. That's something that we would like for building a portfolio of diversified factors, but these are long-short combination of factors, and they are not necessarily achievable in practice. And then if you have that short-selling constraints, that might reduce a lot the diversification potential. So,
well, you're asking me to do something that I didn't set out to do, which is to give an asset allocation procedure for yeah. So I thought it was enough to just identify whether there was a factor or not. But you're right. I mean, for example, there is one case here where suppose you have a factor candidate that's not related to any of the riskiness in the covariance matrix, right? Then there's an asset allocation procedure, because what you do is you set up a portfolio which is long positive betas in that factor and short negative betas in that factor, such that all the betas are zero on the true underlying risk factors. Okay. And then you diversify as much to get rid of as much idiosyncratic risk as possible. If that portfolio, which has no systematic risk and minimal idiosyncratic risk, has a positive return, you're in heaven, right? Because that's the kind of asset allocation that could be done here, but it requires you to know the betas on the true underlying factors in order for you to do that, right? Okay.
My question is about the primitive of the model. So you start from the assumption that the risk factors are high frequency factors. So you need to look at ETF because you don't, and you rule out microeconomic factors because you say they are too slow to explain stock market fluctuations. There is a very, very famous model in finance, which is the Kyle model, and we assume, and a huge class of model assume that there are noise traders, and that these guys move the price at the low frequency, and you could still have macroeconomic factors at the low frequency and noise that makes price move in the high frequency, and macroeconomic factors may still be the ones you would like to look at. So my question is, why rule out macroeconomic factors? If you have noise traders, you could just look at
I didn't mean to say that they're only macroeconomic factors. I mean, I think there are lots of other possible factors. Of the 316 factors suggested, only a few of those are macroeconomic factors. So I was just saying that theoretically, the things that are going to be driving the aggregate market portfolio, the things that you can't diversify away from, should be something like macroeconomic factors, right? Most other things you should would not affect this giant diversified global market portfolio. I don't mean to say that that's anything more than just a presumption, though. You know, there could be lots of other things that are driving that. You know, I mentioned, for example, behavioral factors, right? It could be that, you know, panic suddenly hits, and that happens every so often, and, you know, you ought to be able to protect yourself against that, right? Yeah. Yeah, yeah. That's
Okay, then thank you again. And I invite Anthony Attia, CEO of Euronext, to introduce the next roundtable.
Thank you so much for the Institut Louis Bachelier to allow Euronext to give a little introductory speech for the next panel. I'm very honored to speak after Richard. Someone said to me a few minutes ago when we were gathering here, why does an exchange think it's useful for us to be part of a forum like this one? And the answer is very simple. The role of an exchange is to organize markets in a transparent way and provide liquidity and make sure that investors have a diversity of vehicles to invest on, and also to channel the investors' money into capital, help companies grow and raise money, but also help finding out what's the right vehicles and the right pools of liquidity will be. And so I think it's a role of an exchange to promote research and to make sure that the variety of tools that we have for Euronext, talking about our indices, our ETF, our derivative listed product, are still relevant today. And this is why at every time of our strategic build, we think about innovation, and we wonder what it is to innovate being an exchange. And here again, the answer is very simple. We can't innovate on our own. We need to work with you guys, we need to work with our clients, we need to work with investors to make sure that when we talk about the CAC 40 as an index, for instance, we show that the calculation method and the way the CAC 40 is used are still up to date and are still modern. So this is why we want to be very involved in this kind of in this kind of work. 2 years ago, when we carved out Euronext from the ICE group, New York Stock Exchange ICE group, we also decided to bring some innovation and modernity in our strategy. And for some of you who know le Conseil scientifique du CAC 40, the scientific council of the CAC 40, we started a work to reform it and to bring more modernity, transparency in the rules, and change in the composition of this council. So 2 years after, we have created a new index advisory group composed of academics and practitioners of the asset management industry to advise the scientific council of the CAC 40 on the best way to change the rules, to keep them up to date, and to build new additional indices series. And so I'm very pleased today to announce that this composition of the Index Advisory Group includes some of you here. So with Charles Albert, we thought there was a good thing to to share the names with you. And so we have we're lucky enough to have Nicolas Gossel from Lixor, Marie Brière from Amundi, Olivier Guéant from ANSA Paris Tech, Mark Sinsheimer from ICN Business School, Nicolas Samaran from Invesco Power Shares, Frédéric Jamet from State Street Global Advisors, Serge Darol from Université Paris-Dauphine, and of course Charles Albert Lehal from the Imperial College in London and a member of the Capital Fund Management in Paris. And so this group is advising the Scientific Council of Euronext to help finding the right tools and the right vehicles for investors. And we hope that the academics in the group will be able to publish research papers that are that are connected to the discussion that we're trying to organize. Anyway, I'm going to try to keep it short, and I just want to announce the panel. So we have Charles Albert that will be the moderator, and we have Mark Seinsheimer from as an independent consultant today. We have Xentia Rulik, head of quantitative research at OSIAM, Ian Webster, managing director from Axioma, and of course we have Richard Roll. And so I just want to applaud them, and I hope the panel will be heated and full of debate. Thank you so much.
Okay, so to launch the debate, so we had some discussions before the panel, and to try to understand why we are all there today, and we discuss about factor investing and smart beta. Maybe a good way to start is to try to understand why there are that much attention on this kind of topics today. And maybe Richard, you can start, and we will go through all the panelists about this topic.
Well, I think the reason is that it's it's necessary, because there really are multiple factors, and that means smart betas on a bunch of different factors. And if you don't recognize that, you're going to be suboptimal in your asset allocation. I think it's just reality. You know, after 40 years, you know, the world has finally come to the realization that there are multiple factors.
So I'm talking from a point of view of an ETF provider, and actually the interest as we see it now in factors is something new, even if the factors are around the world for a long time, as Professor Roll told us, and many of us know. Still, if you think about Europe, for example, 6-10 years ago, you didn't have much of style investing or factor investing. If we think, my message is to make it short that I think ETF played a role here, and ETF together with smart beta were important, and just not to take much time, I will mention two key things. In this regard, as I said 6 years ago, almost nothing we have seen in the ETF, for example, assets under management for factor like tilted funds or factor exposure. ETFs were really very, very small, less than 1% of total assets in the ETF at the time in Europe, and with very small amounts invested. There were many reasons why factors were not particularly interesting for investors in Europe. We thought of some of them as we were thinking about interest of such kind of investing approach in the past, but very much focus on country investing in Europe. So people slice and dice mostly on country risk here in Europe. Markets were not deep enough. Indices and research concentrated on the US, style indices, value and growth indices, for example. So there were many reasons for this, but then something happened in these years, and I think important things came from academia and research, as well as ETF. There were papers in 2011 published, so there were already interest in smart beta ETF, so they were smart beta strategies or alternative beta strategies. They were new, people were curious about them, and but from the beginning they were presented on the basis of explaining the methodology, the mechanics of portfolio construction, so equal weight, for example, minimum variance. So we talked to investors explaining what the strategy is doing, how the portfolio is constructed. And the paper that I mentioned, I was about to name, is a 2011 paper in Financial Analyst Journal from Little. It was entitled Survey of Alternative Beta Strategies, and it was their paper who introduced the concept that all the well-known smart beta strategies are related to factors. So they made this table factor regression. I think this is one of the most cited paper now for when we talk about smart beta strategies. And their key message was that many strategies are just exposed to the same factors, and the factor combination will do as well as the strategies do, and so it made a common denominator that helped investors a lot to understand the strategies and to frame them in terms of factors that were already similar to from the academic literature. And another important paper that was in this year was a paper of MSCI that was entitled "Harvesting Risk Premium of the Equity Strategy." So the first paper related clearly smart beta to factors, and the second paper just was a clear message, let's go harvesting these factors. And since then, I think when we talk to investors about smart beta strategies, the first question maybe is not what is the portfolio construction, but what is your factor exposure. So sorry I was a bit long, but
thank you. So there are two issues really. There's the risk factor and then the smart betas, and both issues are linked, but really rather different, I think. So risk factors, I think, have always existed, and Richard invented them to some extent, and they came as essentially they've operated well in the risk management space, and with active managers there was a very good interaction between the investment managers, the asset managers, and the risk managers who were working on the risk factors. And through this interaction, something happened, okay? Now, the attempt initially to develop APT into an asset management procedure was not as well recognized, I would say, as a risk management tool. Pharma French introduced something different, which was sort of apparent in the presentation by Richard, which is the jointing of style management and factor investing. This is where there was a sort of convergence of both things. This was in the 90s, and it developed. Eventually it got picked up by essentially Morningstar and became the be-all, end-all of what is called ex post facto risk management, which is style analysis of performance. So the identification of the real added value of the asset manager came once the factor risk premia were taken away from. I mean, alpha was whatever was left once you've explained everything else. And there was a greater and greater explanatory power. But still, it was not really in the investment management space, I would say. And it was, what's interesting, I find, is that it was still more or less into a fairly efficient market framework. That is, what we spoke about risk factors, we also spoke about anomalies sometimes, et cetera, and this terminology apparently has disappeared and been taken over by all these risk factors and the zoo that we were talking about. So the real issue, I think, in developing the interest now for smart beta and eventually risk factor investing is the fact that we were not very good in risk management at the end of the day because of the crash of 2000 and the crash of 2008. And there was a reckoning. Obviously, part of the reckoning, I think, is smart beta, saying, well, markets are not efficient. Cap-weighted benchmarks are only following the herd, and you should not do that, and hence you need to find something which is slightly smarter, be it fundamental driven or limiting the volatility or mean variance, etc. Whatever is not cap weighted was in the flavor of the day. And there were explanations to do that. On the risk factor basis, things progressed more and more. And now we are dreaming to really creating a list of not asset classes, but factors of performance through which, and there was Marie Briere's question, we will be able to restructure completely the world of finance. So we're at the crossroads now, and the question is, to what extent do smart betas help factors, or do they confuse the matter?
Thank you. Yeah. The problem of coming at the end of the panel is that there's an awful lot been said, so I'll try not to be too repetitive around this. But before I think you can answer the question of why now, I think you have to think about what the actual purpose is that people are using these factors for. And we've touched on this a little bit, is that certainly what we observe is that there's two very distinct usage. One is within terms of hedging, within terms of risk management, that's been talked about, and the other was in terms of this is just a strategy that I'm going to hold. It's a long only strategy or a long short strategy, but I'm using this as part of my asset allocation. And so those are two very different use cases, and I think when you look at why now, there's two very different reasons. So on the hedging use case, I think this very much about what's being said before, which is people are now understanding after the crash that there is systematic factors in the market that you can hedge against, and that it would be rather silly not to take those hedges, not to look at your portfolios at an enterprise level and really understand what factor exposure you've got. So factors and your understanding in risk management is very clearly one of the drivers now. The idea of using factors as an investment strategy, I think, is driven by two separate things. One is one that was talked about earlier, which is the ETF space. Clearly, the ETF space has needed to drive innovation. Is that if you're an ETF provider, there's a distinct advantage in being first to market. So if you can get your product out there quickly and early, you tend to gain the assets. Therefore, ETF sponsors who've wanted to come to the market have had to come up with new ideas. Therefore, factors are a great new idea. Obviously, 40 years taken to get them to be new, but they're new that you can package them up in ETFs. So there's a real desire from the ETF sponsors for something new, and those factors have provided it. I think when you look at the asset owner drive into the factor space, which is also very clearly there, that drives to something different that happened after the financial crisis. And that was a real crisis of understanding whether asset owners were getting value for money from their active managers. And looking at the factor products that have arrived at the similar time, people could see that they were getting, at least on a back-tested basis or a theoretical basis, outperformance from the passive products, perhaps not as great performance as some of the active products, but at a considerably cheaper cost. So the idea that active managers had perhaps become a bit too much of index trackers themselves, that perhaps that they got a little bit too greedy within terms of the fees, meant that the asset owners were looking for things that would allow them to outperform the benchmarks, but at a different cost. So I think from that asset owner perspective, cost very much drove the now discussion. Not that it's new, but it's why it's happening now.
Yes, thank you. To continue this discussion about, synthesizing something that is close to active management. So what about the cost? Because you can have a lot of factors that you can ask to be computed by index, by any index, and for in the index. Then, if you've got to invest, you've got a lot of costs that appear. And so, what is the difference between if you say it's about factors of performance, investable factor, ETFs, so products, then it's not only enough to be a factor, you've got to be a factor that does not cost too much. So what about the liquidity? What about...
Do I get to go first this time? See, I was last time and have the discussion there. I think that it's a very important discussion about how much one should pay for a factor. Or even a discussion that sort of takes a step up from that, which is where should your factor allocation come from? Should it come from your active allocation? Should it come from your passive allocation? And I think different people push different views around that. That said, when you look at the pricing of the ETF products, or you look at the pricing of the swapped-based products, or you look at the pricing of institutional mandates, which are driven off factor indices, then they're significantly cheaper than an active variant of it. They're more pricey than a market capitalization weighted index, that's clear, but they're quote-unquote cheaper. within terms of looking at that. Now, I'll give a little bit of an anecdote about why I personally don't think that that should necessarily worry active managers. I think it should worry lazy active managers a lot, but I still think that there's active managers out there that can really work through this. The anecdote is that Axioma launched with stocks a minimum variance set of portfolios. They went out into the market, and we were talking to a number of our clients, not about these particular products, but about our portfolio construction technology. And one of our clients said to us, we really, really don't like the fact that you've introduced these minimum variance products. We've got an active strategy that's minimum variance, that's performed very well, and we get great fees from it. You're undercutting our market. We said, we apologize, but it's the way the market's going. We talked to another client a couple of weeks later who said, we love the fact that you've introduced a minimum variance index. And the reason that we love that is that we can now benchmark our active strategy to a minimum variance index and really prove to the asset owners that we do outperform and that our costs are viable and are justifiable. And so I think that within terms of looking at whether this is a threat to active management, I think those active managers who do believe that they have a benefit can continue to charge those fees that are out there, but the bar's just got a little bit higher.
But just to complement on the pull perspective, there's a push perspective obviously as well. And what's interesting with the push sector is that for traditional passive investors, they were not making much money. So there were strategies for new entrants and wannabes in the ETF space to come in and to provide something completely different, which was a smart beta, and they would have perhaps a lower asset base, but slightly larger fees, and they would be able to exist in an ecosystem which is very, very difficult to come into. Barriers to entry are very large in the pure passive world. It's dominated by the big players. So there was one avenue this side. And what's interesting is that there was another push on the hedge fund space where some hedge fund managers were saying, okay, so I've got a good alpha factory, but is my alpha factory scalable? Not really. If I would be selling factors, maybe that would be better. I could grow. So you had AQR, obviously, and Bridgewater with all-weather portfolio, and a few others started moving into this space wherein they would bundle the risk factors together, and there would be a know-how answering your question to some extent, because the implementation phase obviously is rather important. So the theory is there, it's based on academics, everyone tends to agree, but the question is how to put it in the market. And I think the hedge fund space was the first to bring it in, really. I mean, the multi-factor investing. Now, coming from the asset owner's perspective, it's still much cheaper. It's still very palatable, but at the end, it's only like 0.5% of assets under management, so it's really anecdotal. In theory, it should not even warrant this discussion, but it is important because it perhaps, and this is what I guess we all believe to some extent, that it could be at least the premise of something completely different. Right now, the asset owners are happy in two ways. Either it's the new thing, and they will completely revamp their portfolio, or worst case scenario, it complements very well what they already have, and it diversifies their portfolio. So what's interesting is that both paradigm can coexist in a fairly efficient way. Last very short thing is ETF is the revolution, because now we've moved from, I don't know, paper portfolios and factors and thin air to real investable portfolios. And through, I don't know, some Darwinism that financial markets are very accustomed to, something will happen. I mean, we will be able to analyze risk using ETFs, and ETFs will represent the risk by definition, and some kind of equilibrium, I think, will find its way over time.
Kenya, yes.
Thank you. Just maybe adding more technical detail about the replication. So I think there are two different things we can talk about. The first is how do I build my factor portfolio or my strategy portfolio. So this we can call it implementation in the sense how do you put the idea into work in the portfolio construction, how you assemble your portfolio. I can give you an example. Jan mentioned the minimum variance, so there are many ways to build the minimum variance optimizer, to put the constraints. One can even go a simpler way, build a low volatility portfolio, just selecting low volatility stocks. So, and actually implementation matters. First, because it can, the resulting portfolio can be more or less diversified, which actually is important for an investor who will take this index or factor, for example, as an investment objective. If we're talking about factors that are not investment objectives but more risk management ingredients, then the interest is to make it as pure as possible, maybe uncorrelated, retreat other effects. So implementation matters. It matters for what are you implementing, and so the particular methodology chosen can make an effect, so one has to take it into account. The second level, technical level of implementation is actually trading costs in the market of maintaining a true portfolio and not a paper portfolio. And the costs obviously they depend on the liquidity, on the concentration of the portfolio, on the market, on which, so if it's a global portfolio with a lot of emerging countries, the costs are different. Actually, it's true that ETF show quite low management fees. Implementation fees due to trading might increase the effective cost for the investor. So, and it's again, it's the same maybe logic if one wants really to build an investment objective with this factor exposure feature, then some cost-conscious portfolio construction, liquidity filtering will be welcome. So there are really different levels of implementation, but of course ETF industry is working hard with all other players on this.
Just to go back to what you were saying, you know what, one thing you have to remember is that every portfolio, no matter how it was formed or who did it, has three components. The first component is the degree of diversification that it has, so the idiosyncratic volatility. The second component are the betas against the true underlying factors. Now, most people don't know what those are. Most investors and most money managers, they don't have a clue what those are. But every portfolio is driven by those factors. You can't escape that. So one thing, just, you know, the bottom line would be nice to know and to let investors and other people know what really is the loadings that you have on each of these underlying factors. That would tell you your risk profile of the factors, and then you would be able to see, well, could I adjust that? I mean, it's the same thing as if you would say, let's say there are 5 underlying factors. I could take 5 ETFs, and if I weight them properly, I could mimic those factors and get exactly that component of the portfolio. And then there's the third component, which is the alpha. The alpha, you know, there's nothing in factor investing that says that active management is wrong. It's perfectly okay. If you can adjust your portfolio to have the right risk profile and minimize the idiosyncratic risk and produce an alpha too, that is.
I think the problem is that many active managers were dressing up factor management.
Yeah. But to know what the alpha is, you need to be able to know what the factors are in the factor loading. So, you know, if you don't know what those factor loadings are, you know, everything else is just murky. You don't know what you're talking about, right?
Yes, you know this famous picture with the proportion of alpha available in the market. Each 10 years you've got less alpha because people identify new beta, new factor. So and is beta something else than an alpha that survives long enough to be identified, and now it's no more an alpha. So what is your view about that as a researcher? I mean, is your work to target some alpha, and if they are viable long enough, now you try to label them as a specific beta, or these kind of risk drivers?
Well, you know, I was trying to say when I was talking earlier about non-stationarity. which is endemic in financial markets. Things change every single day in terms of the risk profiles, the betas of individual stocks, the expected returns, and so on. So, you know, I think the key for a key for an active manager is to be able to change, you know, change their strategies and update them. Of course, you know, if you're going to have, if something is obvious in terms of producing an alpha, after you adjust for the risk, the systematic risk, everybody's going to figure that out pretty quickly, and you're not going to, it's not going to be around very long, right? So, yeah, that's.
I don't know whether this works, but I just wanted to add one thing that none of us talked about in terms of why now. And as the presentation was being talked through, it really came to my mind. You were talking about, oh, well, covariance matrix, let's calculate that on a daily basis. I know that's a tough job. It's no longer a tough job. Technology has made it very, very easy. We produce intraday covariance matrices that you can work with, and of course you can ask the question whether that's too much noise. But I do think that the technological advances that have happened over the past 20, 30 years have made this much, much easier to be mainstream, as opposed to requiring an awful lot of geeks in the back room running with enormous technology.
Yes, the technology and the availability of data allows to compute a lot of things very fast and very often in the market. Nevertheless, the liquidity is not that much there compared to even 10 years ago. So maybe you can identify faster some need to move from one factor to another, but at which cost? And in terms of liquidity, you've got this implementation that is not that easy. So when you sell an ETF, I mean, what kind of promise can you make about the liquidity cost of maintaining? If you've got more and more AUM on it, it will be more and more difficult, most probably. So how do you deal with that practically?
As you know, the majority of factor, multi-factor and smart beta products are on equities, and especially on developed equities where the costs are constrained, and the markets, at least US markets, typical example, are quite deep. So the funds, the ETFs of the current size that we see in the market, I don't think have really big problems of liquidity in equities. In Europe, maybe things are more concentrated on the biggest stocks, but in general, what I can say from our experience, we believe that the scalability can be implemented in the portfolio by screening the stocks by liquidity before letting them enter the portfolio. So this is something that will ensure let's say, the consistency of the strategy in the long run, and will answer the capacity question. The situation is much more difficult in bond space, and well, there is no magic. The answer is to take care of rebalancing frequency, transaction costs, to think twice whether we really need to make this trade, what is the real adjustment, what is a noise adjustment, according to investment strategy. So because there's, well, if there is a modeling, for example, or estimation, there might be also some estimation noise. So that's implementation part that has to be taken carefully and well thought in advance. Still, well, we were lucky with equity. With equities, we were able to let our fantasy run and implement things very diverse. Still, yes, this is one of the questions which is important and maybe will become more and more important.
I think you certainly have a point, and it's your turf, really. So liquidity, okay. So I believe that there is an illiquidity premium. But if your question is when are we going to be able to have a liquid trading of the illiquidity premium, I probably think that the answer is not too soon. Okay, so the question is, yes, in terms of the overarching asset allocation exercise, there's probably a limitation to the sophistication that you're discussing, etc. It is limited to tradable liquid assets, and there's part of the portfolio which needs to be put into, I don't know, other real assets, real estate, etc., small caps, so venture capital, infrastructure, blah, blah, blah. And you will not be able to compute the overall risk of the portfolio so specifically. But let's hope there's going to be some insight. Let's start with what should be easy and do it well, and hopefully it will spread out into the other areas so that we will have indicators for the overall portfolio.
I think there's even a liquidity premium in the S&P 500, so you could probably trade that quite easily. So it's not that far away in terms of looking at liquidity.
On the run, off the run, or swap spreads, and
all sorts of things. But just going back to the question about the liquidity issue, and I think that maybe attack that from a slightly different perspective, which is where conferences like this come into play, is that from an academic perspective, identifying factors is one thing. From a practitioner's perspective, implementing factors is something completely different. And so the question that came earlier about, okay, well, can I do long short? Because clearly if I want purity in my factor, I'm going to come up with a long short basket. Most firms can't go short. So that, by definition, I'm going to get rid of some of that purity of factor, and by looking at that. So I think that there's some discussions that need to happen from an academic perspective, which is not looking at factors but actually look at the way that factors have been implemented in the market. If you think about the active industry, there's a whole industry on top of active management, which is called consultancy. At this stage, there's no industry on top of the smart beta index, or there's no industry on top of the factor indices, because what one reads in the academic papers is all very, very clear and very straightforward. What one reads in a prospectus is usually clear and straightforward. That's what prospectuses are for, but the difference between the academic paper and the prospectus is enormous. And so looking at how the actual performance of the products perform as opposed to the theory, I think is something that bears an awful lot of research. And I was sort of surprised, in some senses, looking at some of these characteristics to identifying a factor, that some notion of liquidity, some notion of making sure that it is investable, perhaps ought to be looked at in there.
Well, just a word about liquidity. I agree there are liquidity premiums, and there should be, because if you're going to buy a liquid stock, it's got to have a lower price than... So there you go. You hold that for long enough and you're all right. But there's another aspect of liquidity, which is there is systematic liquidity that affects all, that changes over time. So sometimes the market in general is less liquid than at other times, like when you have a market meltdown. And different assets have different betas on that aggregate liquidity factor. So some are more susceptible to that liquidity effect. So it's like another risk factor in a way. There's several papers on this, Pastor and Stambo, I mentioned a few of them, but what they do is they estimate aggregate liquidity shocks and then look to see how individual assets respond to those aggregate liquidity shocks. And they show in their paper, they estimate at least, that you get paid for this pretty well. Like if you've got a beta of 1 on the liquidity, aggregate liquidity shock, instead of a beta of 0 in that, you get something like 300 extra basis points in average return, according to their estimate. So it's a significant thing. But there are two aspects. You know, the liquidity premium is more like a yield premium on a low-grade bond, in the sense that, you know, you're paying for that, right? But this other aspect of it is systematic liquidity is, it's just another risk factor that every portfolio has, although most people don't know what it is. Right? So.
Yeah, thank you. I've got another question for you, because at the start of your presentation, you say, okay, I will take care of equities. And what about other asset classes, seen from a factor viewpoint? So we had discussions before the round table about what about cross-assets, ETFs, cross-assets, smart beta, and so on. And what is your viewpoint about that? Could you identify some factors that are cross-asset factors, or each asset class has its own span of factor, is spanned by different factors?
Well, I don't think the evidence supports that each asset class has its own set of factors. I think they're common across asset classes, but they don't have the same betas on the factors. So bonds have their own set of betas on the factors, and stocks have a different set of betas, and commodities have a third set, and so on. But if you extract from all the joint returns of all these asset classes, you'll see that there are common factors. It's just that the factor loadings are different across asset classes, and that creates a change in the correlation between asset classes, for instance.
If I can push further on Charles' question, do you think there's some kind of paradigm shift? I don't know what it's linked to exactly, but there used to be a business cycle, and it was typically good to be invested in bonds in the recession period and stocks in the expansion period, and you would buy cyclical at the end of the... Where's all that? Well, and when we were doing data mining in the past, how much signal are we capturing from this good old days, which does not really apply to today's?
But the answer to that is in the correlations, and although that your presentation showed those correlations over a 10-year period, as you know, those correlations moved around enormously in those 10 years, and they hit one during the financial crisis.
I showed them period by period. I have a different correlation matrix every month.
Right.
Okay, and it's not just updated like the last 60 months. This is actually a different covariance correlation matrix every month. That's using that technique, I think. But getting to your question, I think there's a controversy among financial economists about whether or not there's changes in expected returns in different asset classes over the business cycle. Maybe there's some evidence for that people like John Cochrane think there's strong evidence that when we have a bear market, expected returns go up on certain assets and they go down on other assets, relatively speaking, right? So that means that there is a reason, if that's true, that you would change your asset allocation as a function of where you are in the business cycle to get the higher expected returns that are there in some classes. Right?
The question is, to what extent are we not a little bit, like, I'm sorry to be anti-French, but fighting the last war? Always over sort of fitting towards a world which doesn't exist anymore.
Well, as I said,
obviously it's competitive as well, even regarding the variance-covariance matrix. If we have, what I can't understand is, if you got two securities which have a very large correlation, high correlation, typically asset managers will arbitrage one against the other. Therefore, they buy one and sell the other, and they'll destroy the correlation. So there's some kind of vicious circle here, and it works in reverse. If there's a low correlation, you'll buy them or sell them together.
And I think the debate, and I very much like the way that it's presented, is are these factors driven by the underlying macroeconomic events or underlying corporate asset values, or are they actually driven by market events? And I'm not sure. I don't have the data, I haven't seen any research that sort of says, you're clearly saying that these are driven by macroeconomic, by corporate valuation factors, and that suggests clearly that just because I've used a different instrument to raise capital, that shouldn't really concern me about where I should invest. I should be if I've gone into the equity market, I've gone into the bond market, ultimately I'm taking a bet on that underlying economic. Yeah. My personal fear is that you're no longer taking a bet on the underlying economic, you're taking a bet on the market dynamics of that particular capital market.
Okay, thank you. I guess that we've got to end this wonderful debate. So maybe you can have the last word, Richard.
No, go ahead. I don't need a lot.
Okay, so maybe we can take one or two questions in the audience for the panel, if you've got.
I fully agree with Dick about the issue of non-stationarity. I think that that's really the major issue in fund management, that statistics do change all the time. Usually we assume in all the beta estimation, all the regression, we assume stationarity. But the fact of life is, and we see it in the VIX index, distribution change all the time. And the question how we introduce and how we incorporate those dynamics in a systematic way.
Who takes the question?
Is that a question for me?
I don't know, I'm not sure.
Well, I suggested a method there. I have to explain it more to you maybe tonight, but that, you know, I agree with you 100% that the most serious problem we have in asset allocation and investments is really non-stationarity in the underlying base. You know, everything's changing all the time, and we have to have the econometric tools to handle that. There's no other alternative, really. So it's just a question of whether or not we can develop, you know, good enough econometrics to measure the non-stationary components of these things. I mean, believe me, we're not there yet, but you know, that's the holy grail. Right?
Just from the practical point of view, what happens, this non-stationarity is usually expressed as time variation in factor premia, so in expected returns, and one of the things which is done currently is to diversify, so take different exposures and hope that the portfolio will be weatherproof in the future. So this is one of the ways of tackling stationarity.
But I think that you've seen the notion that within terms of particularly factors and multi-factor indices, so it seems to me that there's two different approaches. You can either take the view that you'd be able to market time the single factor index, because clearly they have different characteristics over the cycle, or you can buy a multi-factor product which aims to weight those factors appropriately to have minimized drawdown, probably caps returns on the upside. So you've got two different alternatives to do that. Neither of them are necessarily easy to resolve around it, but I do think you've got to recognize that factors clearly have characteristics in different markets. So the idea that you should buy a factor and go away is not going to be a sustainable one.
I still will go along to some extent that risk management is mostly a hard science, even though it's dealing with history. I mean, you have real data, you're dealing, and investment management is dealing with the future, and it cannot be a hard science. So we need, as investment managers, to make the best of what we have regarding the past, but we still need to make a story to check that it works well and to make a bet. But obviously there will be an element of judgment. I mean, we can, or else we just say, yes, the future is going to be like the past. Go forward. But that's driving by looking in the rear view mirror. It's pretty dangerous.
Another question?
Hello, Yves Louis. Speaking of factor analysis and investing and the time varying nature of variance covariance matrices, what's the relation you've been able to identify regarding the depth of your time series in history and the horizon of investment? Because there is a lot of noise in those correlation matrices. And what's the relation? You take 100 times, 1,000 times the investment horizon?
Unfortunately, there isn't a right answer to that in practical sense. is that quite often one's dealing with the data that's available and trying to go back as a long period as you possibly can within terms of looking at things. So it's fairly straightforward to get from the US market daily observations back to the 1980s with very, very robust data sets around there. Rest of the world is slightly different around that, but you've clearly got to be able to create products that look at the market through many, many different business cycles and the evolution of the market itself. I personally don't think that there's a right answer to your question. It's there's no. It's never far enough, but it's obviously getting further and further every day as we add data onto it.
Well, I would answer that the same way, and you use all the data that you have available, but remember that since you think that these covariances and correlations are changing over time, your current estimate looking forward from today has to depend more on the recent past than it does something in 1960, right? So the econometric techniques that I mentioned here do that. They have a method of updating those things to give you the best forecast for tomorrow, given what you know right now. That doesn't mean you ignore everything that happened a long time ago, but you know, you weight things implicitly more heavily in recent past. And by the way, I should mention that when you go to global asset allocation instead of just asset allocation within, let's say, the US or Europe and stuff like that, this question of factors becomes even more critical. And the liquidity also becomes really critical, because if you have, I think there are about 80 countries where the equity markets are liquid enough that you could reasonably do this kind of analysis for, right? And you can only do it back as far as about 1970, something like that, right? So it's really, and some of those countries came in later, of course, and so you don't have a complete data set for every country, which means that as you update these correlations, you add additional markets into the equation. So you have to have a method for doing that as well. But I will tell you though, if you do this as well as you can do it, for 80 countries, 10 factors are enough for all 80 countries, which is kind of good news in a way, I think, right?
So we will end with these few numbers of factors. So let's thank the panelists.